All right, think about this for a second. You work hard for your money, right? I mean, we all do. We go to school, we get a job, we save up. So, how is it possible that trillions of dollars can just appear out of nowhere? Where does it all actually come from? Well, here's the first surprise. What if I told you that the government actually creates almost none of the money we use? It's kind of a shocker, but in most modern economies, a whopping 97% of all the money out there is created by private banks, just digitally. The stuff in your wallet, the cash, that's only about 3% of the total pie. So we gotta ask, what's the deal with that other 97%? Okay, so to really wrap our heads around this whole thing, let's start with what we do know. The small stuff, the actual notes and coins we carry around. So this physical money, the cash, is made by the government, and its main job is really just to make sure there's enough cash for the ATMs. But here's a little known, kind of cool fact. If it costs, say, 3 cents to print a $10 bill, the government makes a profit of $9.97. That profit has a fancy name, seigniorage, and it actually helps lower our taxes. Pretty neat, right? Which, of course, leads to the obvious question. I mean, if the government can literally print money and profit from it, why not just go crazy? Fire up the printers, pay for everything, and get rid of taxes altogether. Sounds great, doesn't it? Well, the answer is one word: inflation. It's a huge risk. Look, if politicians had a magic money button, you can bet they'd use it for every project or promise they could think of. But the problem is, the more money that's out there in circulation, the less each individual dollar is actually worth. The analogy I like is thinking of money as a measuring stick for value. If you just keep stretching that stick, making it longer and longer, pretty soon it becomes totally useless for measuring anything. Okay, so that covers the 3%, the small stuff. Now, let's get to the main event. Let's pull back the curtain on that other 97% and see how the real money machine actually works. The whole thing, and I mean the entire system, is built on one simple but incredibly powerful concept: the promissory note. All it is a written promise from you that you'll pay back a debt. Simple. But, and this is the key to everything, in the eyes of the law, that promise, your IOU, is considered to be just as good as money itself. And this right here is probably the biggest misunderstanding people have about banking. We all have this image in our heads, right? Banks take in savings from person A, and then they lend that same money out to person B. Makes sense. But that's not what happens. The reality is, well, it's way more shocking. When a bank gives you a loan, it doesn't use anyone else's savings. It creates brand new digital money literally out of thin air. Let's walk through a real-world example. Say you're getting a $500,000 mortgage to buy a house. First, you sign the legal document, that's your promissory note, promising to pay it all back. Then, someone at the bank literally just types the numbers $500,000 into a computer, and poof, suddenly $500,000 appears in your bank account. That is brand new money. It didn't exist a second ago. It was created from absolutely nothing but your promise. Now get this. Here's the other half of the magic trick. As you spend the next 30 years paying back that loan, that money gets destroyed. It just vanishes. The debt disappears, and the money that was created from it disappears too. So what's left behind? The only thing that stays in the system is the bank's profit from all the interest you paid. That's it. So let's zoom out for a second. If most of the money in our pockets and accounts is just debt created by banks, what does that mean for the entire economy? Because this is where it starts to get really, really important. It leads us to a pretty fundamental rule of our current system. Since new money only gets created when people and businesses take out loans, our economic growth is completely tied to creating more debt. Think about it. If nobody takes out new loans, no new money gets made. And if there's no new money, the economy actually starts to shrink. Okay, so where do banks like to create all this new money? Well, they're businesses, so they want safe bets. And for a bank, there's nothing safer than a mortgage on a house. Why? Because if you stop paying, they just take the house. It's great collateral. And the consequence of this is huge. The vast majority of all new money created in the economy gets funneled straight into the property market. And what happens when you pump trillions of new dollars into one specific market? It drives up prices for everyone. Now, any system that runs on debt is naturally going to have its ups and downs, booms and busts. But over the last few decades, a couple of major events have happened that have completely rewritten the rulebook. And this first one, this is a really big deal. Banks always had this rule called the reserve requirement. They had to keep a certain fraction of their deposits on hand, maybe 10%, just in case. But in March of 2020, the US Federal Reserve quietly changed that requirement to zero. 0%. What that means is that, in theory, there is now absolutely no limit to how much money a bank can create. And it gets even wilder. Banks don't just create money through loans. They also make these gigantic bets in the financial markets using something called derivatives. It's basically high-stakes gambling on where prices are headed. The estimated size of this derivatives market is over $1 quadrillion. A quadrillion. That is more than 10 times the value of every single thing produced in the entire world economy in a year. It's just a staggering number. So how did we even get to this point? Well, you can kind of trace it back. In 1971, the US dollar was taken off the gold standard, which basically made money elastic. It could be stretched. Then, in 2008, we had the global financial crisis, and the biggest banks were called too big to fail and got massive bailouts. And finally, in 2020, as we just saw, the last of the major guardrails came off with that 0% reserve requirement. Okay, let's put all the pieces together. Why should you care about any of this? Why does this whole system of creating money matter in your day-to-day life? Well, it's because it has a direct and absolutely massive impact on the wealth gap. Ever since 2008, there's been another kind of money creation that you've probably heard about: quantitative easing, or just QE. Now, this is different from a bank giving you a mortgage. This is when the central bank, like the Federal Reserve, creates brand new money to go out and buy up things like government bonds. The whole idea is to flood the financial system with cash, hoping to get the economy going. And what was the result? Well, just look at the sheer scale of it. It took the U.S. more than 200 years, from its founding all the way to 2008, to build up less than $1 trillion on its balance sheet. And just the last few years, that number has absolutely skyrocketed. So the big question is, where did all that new money go? Well, the charts tell a pretty clear story. There's an almost perfect correlation. As the central bank started printing all this money, the stock market went right up along with it, almost in lockstep. And that right there, that completes the picture. Who owns most of the stocks and other financial assets? The wealthiest people. So when this fire hose of new money was turned on, it overwhelmingly benefited those who already owned assets. The rich got richer, not necessarily because they created amazing new businesses or the real economy was thriving, but because the value of the stuff they already owned was being artificially inflated. And this really gets us to the heart of the matter. And this quote says it perfectly. You see, creating money by typing numbers on a screen, that's easy. But that's not the same thing as creating real wealth. You know, the stuff that actually makes a society better off. New businesses, life-changing innovations, the skills people learn. So here's the bottom line. We have, without a doubt, created a system that is unbelievably good at creating money. But all of this leaves us with a much bigger, much tougher question. Can that same system create real, lasting wealth? For everybody? That's the real question, isn't it? Something to think about.